The last day of the quarter just wrapped up, and what a win for the bulls. With 2 consecutive quarters of double-digit growth for the S&P 500, it's not looking too good for the bears. But where there is momentum, there is also opportunity, and today we're going to be talking about where that opportunity lies. We're also going to be talking about PCE, Jerome Powell's statements, and what will happen next. We have over 90 years of data to break down and to guide us into what could be a bumpy second quarter. We're also going to be diving into my Twitter portfolios. I gave these portfolios to you at the start of the year, and the Q1 returns have been nothing but stellar, and it's time for an update. So sit back, relax, we've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. I know it's just one click for you guys, but it helps me out so much. Let's get into it. Now, looking at the S&P 500 quarter, now this is Q1 2024 or the year to date, it's the same thing. And these are the returns for every single company in the S&P 500. Now, the S&P 500 has returned 10.2% for the quarter, and you can see the gains are very broad-based across all industries, except for one here in real estate, which has had a rough go of everything. And then other than that, every other sector in the green except for individual names like Intel, Apple, Adobe, Tesla, Boeing, which is crazy when you think about it. Boeing is doing significantly better than Tesla after everything they're going through. But we look at some of the winners. Nvidia up 82%. Google at one point down 8%, up 8% for the quarter so far. Meta up 37%. Look at Walmart, look at Costco, look at drug manufacturers. Kinda crazy. A very good quarter for the S&P 500. Let's look at sectors. Now, the best performing sector undoubtedly semiconductors. Was there ever any doubt? I don't think so. Home builders in second place. Energy, wow, who would have thought my energy call in January would have resulted in a 13% gain. XLC, XLF, XLI all boosting double-digit returns, including the SPY itself, then underperforming the SPY yet still performing great for a quarter in my personal opinion. XLB, XLF technology, XLP software. I hold an ETF. It's called tech. It's actually software companies, but they're more mid-cap stocks, and they're chosen based on relative value, and that ETF is up like 15 to 18% year to date. So just because a sector's on here performing like 6% doesn't mean you can't get outperformance in individual names or in a subsector. For example, if you were in growth staples, stuff like Costco, Walmart, Target, Celsius Holdings, you'd be in the double digits, even maybe outperforming some of these top names. Now, the worst performing sector so far for the quarter, KRE, regional banks, real estate as well, and then metal mining's, up 0.94%, and then GDX up 1.97%, but it doesn't show the full picture because GDX has had a stark recovery from these lows right here all the way up to being positive, nearly a 24% return here in March to bounce back from the trough it was in, nearly down 18%. Now, looking at sentiment, guys, and the sentiment right now is continue to hold, but we are slowly moving from the hold section here to possibly buy equities. With regards to the BOFA bull bear indicator, we ticked down from 6.1 to 5.8. Just 3 weeks ago, we were at 7.1. We keep track of this indicator every single week, and according to this indicator, and I think a lot of it has to do with the credit market technicals as well as overall market positioning, this is actually becoming a buy. In other words, as the S&P 500 hits these new all-time highs every single week, stocks are becoming a little bit more attractive to buy. At the same time, Goldman Sachs sentiment indicator actually ticked down. Positioning went from 2 to 1.4, still very stretched nonetheless. However, that is a good thing considering we're actually moving down in tandem. And yes, the sentiment right now is still hold equities, but based on what's happening here, we're moving more from a solid hold potential sell to a hold potential buy, especially with the bull bear indicator. This is more of a medium to long term indicator. This right here is more of a short term to medium term indicator. So, on longer term technicals, probably looking at 6 to 12 months, the market is definitely becoming a buy. Now, one of the reasons why this environment is more conducive to equity risk has to do with policy. Guys, so we actually got core PCE numbers yesterday. Very interesting. Everything came in line. Core PCE month over month, year over year, and then headline as well came in line, except for the month over month figures. They came in slightly cool. And in my personal opinion, I think the market is going to like this. Headline coming a tad below expectation. The consensus was 0.4, printed 0.3, and I think the market's going to like that. Now, I was going to go over Jerome Powell's speech, but there was literally nothing to go over because he pretty much said the exact same thing that Waller said earlier in the week, and he's just towing the party line, which is pretty much the economy is strong, the labor market is strong. We're not going to look at cutting rates until we have absolute confidence that everything's moving in the right direction. Nothing crazy that came from him, and we did get a tad cooler PCE. I think the market's actually going to like this. I think that, we may get a bit of volatility on the open Monday, but I think overall this is going to be conducive for higher prices throughout the week of April, especially as we exit the window of weakness, and some of the sentiment indicators are pointing to us to maybe get a little bit more bullish on equities as we enter this April period. Now, that was the quarter just passed. What about the quarter incoming? Now, let's actually talk about the first day. Normally, the first day after Good Friday actually tends to be pretty negative. You can see here in every single index, RTY, the Q, SPY, the Dow, we're normally down anywhere from 0.13 to 0.34%. So that's a pretty negative day for an index as a whole. You multiply it by 2 for the sector and then by another 2 for stocks, and that's generally the beta between sectors, stocks, and the index. But then normally we part a lot of those losses in the day after. But looking at April as a whole, what we can expect now, this is S&P 500 forward returns after 5 consecutive positive months. Now, April, we normally return 1.9%. So if we do get a dip Good Friday, that'll be a great buying opportunity for what is normally a positive April. In Q2, Q3, Q4, we normally have pretty positive results: 2.9, 1.5, 7.2% return. The hit rates in Q2, Q3, not that great. Q4 hit rate, fantastic. Then the last 9 months of the year, 100% hit rate. Same with the full year, 11.9% return, 22.1%. And then the next 12 months, so April to March, we're looking at a 14.5% return, 91% hit rate. Very, very positive returns. And ideally what you want is some form of a pullback like we do get at these levels right here to buy the dip, looking for exceptional returns in the full year, the 9 months after, and 12 months after. Now, on the topic of dips that we might get, the momentum factor in April actually normally returns a negative figure, about negative 2.5% on average. Since 1980, the momentum factor has had a negative April. We are in a momentum-based market, so we could actually see a dip in April despite what aggregate seasonality is telling us. And this is because of semiconductors. Normally, the semiconductor ETF or semiconductors as a whole, April is their worst month, negative 1.1% in the last 10 years for April, and you could see very negative returns for the most part here in April. Now, semiconductors have been on a huge momentum run, not just this year, not just last year, but for the last 10 years, and normally they do pull back in April, and this could be a very good dip buying opportunity, because if semiconductors pulls back, the tech sector pulls back, the nasdaq 100 pulls back, and if the nasdaq 100 pulls back, the S&P 500 pulls back, and that drags everything down with it. That's just how it goes with passive fund flows. So we could see a great buying opportunity in April, and then normally that'll be great because we see very positive returns in May, June, July, August, September, October here in the semiconductor ETF, as well as the S&P 500. Now let's actually hop on the charts. So in yesterday's video, we covered the S&P 500 in detail from the monthly, weekly, and daily chart. Today we will be covering small caps, mid caps, S&P 600, S&P 400. Now, starting with small caps, this is the monthly chart. You can see we are in the context of this massive uptrend since about 2012, 2013 right here. And we had this huge ramp up after the government injected a lot of stimulus. We have then come off the highs, formed this massive base, and we are now trying to break out. Now, the monthly candle has closed, and looking at the latest candle, looking at its location and structure, we can see that we have a green body candle, a close in the top 1/3, very bullish, a very long wick, which means buyers came in a big way and not just took us above the open of the month, took us to the close and a 52-week closing high. And actually the last time we had a close this high in the S&P 600 was actually in December 2021. That was the month before we actually had this massive red candle and capitulated to the downside, where we are coming out of this massive multi-year base. But there's a couple of key things that the S&P 600 need to do to continue bullish. Number one, there's two key zones that I want to look at. The first zone is this zone right here, okay? And the second zone is this zone right here. I think that these zones are absolutely critical. These are the two zones where small caps kind of bounced off. It's actually the low of this past month. It's actually the low of this past month, and it's actually a place that we used as resistance here, here, and here, and we are now trying to use that as support. If we can use this zone as support, maybe pull back to the 1317 area and then move higher, that would be insanely bullish. Now, this zone right here is also important because we have used it as resistance multiple times as well, and it has become the main support for this next leg higher if we are to continue in April and for the rest of 2024. So ideally, this is where small caps need to hold the line, because these are such volatile companies and earnings are improving but still down 19% for the year. We really want to use this line right here as the monthly support zone, because we are in the context of an uptrend. You can see here a low, higher low, right? Then we go up, we put a high, higher high, 52-week closing high. We are in an uptrend, right? And we want to continue this uptrend. So we don't want to jeopardize that by potentially getting to the 1270 area here again, maybe making like a lower low on a wick basis. We don't want to do that. We just don't want to risk it at all. So what we want to do in this instance is stay above the open of March, but preferably stay above this line right here. Pull back to 1317 and then move higher on a monthly closing basis. Now that does leave us quite a bit of room to pull back, and if we do see a bit of weakness in early April in smalls, that would be fine. Just look as 1317 as the absolute level on a monthly basis. Now, looking at the weekly chart, and I would actually say that we're probably going to keep these levels on a weekly chart as well. Now, something I do want you guys to know, this massive correction in time that we're seeing right here looks exactly like a Wyckoff distribution pattern. This is what a Wyckoff distribution pattern is. Pretty much we form a massive sort of like resistance right here, support right here, trade in this zone, right? And then we lift off, trade here for a bit in phase D, and then phase E is actually where we break out and exit this zone. If we sort of move this distribution pattern to this chart, you could sort of see that this is where we are in this pattern right here. Now, it's not an exact science. We sort of are in this phase D where we have our resistance lines right here. We've shot up and we're forming this base right here, ready to break out. And it does look like we've sort of started that breakout phase right here in the small cap index with this massive weekly candle stretching from these lows right here in early January. But I would say the real move started in March, especially breaking above these highs that we formed right here and right here in the S&P 600. But looking at next week, let's drop down into the daily chart, and you could see an even more nuanced approach. And on the monthly chart, the daily chart, and even the weekly chart, all of the levels are the same. We don't want to go below this level right here, 1317, 1317. We just want to get to this level if we do pull back and shoot off. But in an ideal world, in a perfect world, we just want to rally on Monday. Now that's obviously all going to depend on how the market reacts to PCE on Friday. But here are your levels for next week. 1317, the first level, and then if we break this level, we can look to 1270. But really, let's stay above 1317 and then go from there, move directly to the upside. Now, looking at S&P 400 mid caps, very strong chart. We're in this, again, massive uptrend that we have been for multiple years since 2012. Now, zooming in at the most recent monthly candle, this is the monthly chart. We're just going to zoom in further. We can see that this right here marks the all-time high. This is the most recent monthly candle, almost no wick at the bottom, a very thin wick at the top, closing in the top quarter, very bullish, new all-time monthly closing high, a new weekly closing high, and a new daily closing high. Very bullish, and very similar to small caps. We actually were in this correction in time, but we have come out of that since, and it was actually stronger than the small cap correction. The reason why it was stronger than small caps was because of this rising channel we were in. It consolidated and then broke out. Very strong when you look at it, and honestly, you don't want to fight the trend when it comes to this chart. Now on a monthly basis, what level are we going to look to for a pullback? Let's say we are to have a pullback here in mid caps. Now a great zone to look at is 27.47. Let's mark it off. So that low right there. So pretty much what I'm saying is if we are to pull back on a monthly chart basis, we can pull back to this level right here and still be constructively bullish and look to all-time highs. Below here, it does get a bit dicey, but 27.42 is the level. So we can pull back as far as there and still be constructively bullish. If we actually are to measure it, how far are we from the top to the bottom? About 10%. So that would be a 10% correction. That would be very reasonable to go ahead and add in a big way at those levels. Does get a bit risky below, but when we get there, we'll sort that out. Now, I'm not saying we are going to pull back. We could literally have like a little bit of price discovery right here and then move up. I'm just saying if we do pull back, what levels we can look at. Now looking at the weekly chart, so this is the monthly pullback zone. Looking at the weekly chart, I think we could actually just look to a level right here, okay? The bottom of this range, 29.29, a nice number right there. The reason I like that level is because it was the all-time high close here in 2021. We have since broken above, and this is where we are right now. A new all-time weekly closing high in the top 25% of the candle. Bullish, very bullish candle, minimal bottom wick, minimal upper wick. Literally just people taking a little bit of risk off in this long weekend at that high. That's all that was happening. Other than that, there is no way that you can look at this and be bearish because we've got literally a low right here, a higher low, then another higher low. I guess you could say a higher low, and then all-time high. Not even a 52-week high, all-time high. At the same time, you know, we made multiple equal highs right here. Higher high, all-time high, bullish. You just can't fault it. This looks very, very bullish. And I think we are going to continue higher. And like I said, this 29.29 zone, if we are to pull back here, we can on a weekly chart. We would still be constructive on the weekly and then move higher. Now, if we do pull back next week, let's say all the way to 29.29 and get below here, that does open up the monthly zone for the week after or in that week here at 27.42. But as it is right now, 29.29 is the level. And if we do get there, I'll update you guys in the week to see if 27.42 does open up. But as it stands right now, I think based on where we found support previously, where the 2021 all-time high currently is right here, I think we would just find very strong support at this level right here, 29.29. And if we are to measure it, how far are we from peak to trough? 3.9%. Imagine that we get a 3.9% pullback, 4% pullback, find support, and then continue the all-time high fever. That would actually be very, very constructive, very healthy in the market. That would be a healthy market environment. We do get about 2 to 5% pullbacks in the market every single year. We could even pull back to a little bit under these wicks, maybe shake out some of the sellers, get some of the bears in heavy shorts, and then squeeze them to the upside if that's the case. But on a weekly chart, monthly chart, this looks very, very bullish, and it's no different on the daily. You can see here the reason why we put up that wick is because a little bit of sellers came in at the top, just taking some risk off in this long weekend, especially with Powell speaking, PCE data releasing when the market's not open. You know, there's no reason to just take a bit of risk off the table, especially after monumental gains we've seen, literally like some of the craziest gains we've seen in the last like 5 to 10 years here in S&P 500 mid caps. Now on a daily chart, what can we actually look at to pull back to? Well, I would look at this level right here. We're going to change this color to white, 29.85. Now I know it's like less than 1% away, it's like 1.2%, but yeah, if we do pull back to this level, I think we find support and then go higher, look to all-time highs. If we do go below this level, I think we probably make our way to the weekly low here at 29.29. But this right here is probably the range for next week. I don't think we're going to break it, given the fact that we are moving into the window of strength. We are looking to OPEX. We're out of the window of weakness. Dealers are going to come in a big way, especially that we are in so much positive gamma, and there's positive gamma in mid caps, small caps across the board. So yeah, look at 29.85 and I will update you guys if things change in that regard during the weekly video. So go ahead, subscribe so you don't miss a beat. Now the quarter just passed is behind us. There is nothing we can do about it anymore, but what we can look at is earnings growth for this past quarter, because that is information we are yet to receive. Now for Q1, this is the expectation 2024. We are expecting 5% return in the S&P 500 excluding energy, 8.1%, with the majority of gains coming from information technology as well as communication services and consumer discretionary. Now this is the S&P 500 Q1 bottom up EPS revisions. You can see that as the S&P 500 has gone up, EPS has actually fallen. This is completely normal, and the reason why we've seen such bullish momentum in the S&P 500 is because earnings haven't fallen as much as the market thought it would, or as much as it usually does according to history. Hence why we're rallying and earnings actually coming in significantly better than we thought they would. What's contributing to this decrease in earnings is actually stuff like consumer staples, healthcare, industrials, and energy. But we look at stuff like comm services, info tech, discretionary, they've actually had revisions upward in their earnings for Q1 2024. These guys have had revisions downward. Now, we do know that discretionary, infotech, and comm services are the biggest weight in the S&P 500, and that's why the S&P 500 has been rallying, because the stuff that do matter have seen upward revisions. Now, looking at the global economy, this is very, very interesting, just the health of the economy. According to BOFA, the broadening is here, 84% bullish neutral signals now versus 43% in March. We've seen a huge ramp up in the first quarter of 2024, leading to pretty much the global economy doing a lot better than we thought, and that has resulted in the global stock market doing a lot better than we thought. And this data right here is based on 50 various growth indicators, and it seems this growth scare we've been in, some people refer to it as the cost of living crisis, is now easing, and we're returning back to a growth environment. And during periods of growth, productivity, and technological advancement, you want to hold stocks. Now guys, looking at earnings in the week ahead, so pretty big week of earnings. I did say in my videos previously that because of how the Fed's inflation goalpost has moved, inflation is going to be less of a concern, and there's going to be a big focus now on employment data. I think looking ahead for the next quarter, we have to put more focus on employment data than we do inflation data. And so starting next week, we have a big employment week. We have JOLTS, we have ADP employment, we have initial jobless claims, and then we have non-farms on Friday. Payrolls, the unemployment rate, average hourly earnings, weekly hours. A big week of employment data, and that is really going to drive flows into Friday. So if we start to see stuff like JOLTS and ADP below consensus, that could really sway momentum to the downside, especially leading up into non-farms. Ultimately, non-farms will determine everything, but just some information I thought I'd let you guys know. Now, the consensus estimates here for non-farms is 216,000 month over month gross, private payrolls 178k, a 3.8% unemployment rate, previously 3.9%, so a decrease, average hourly earnings month over month at 0.3%, and weekly hours at 34.3. I think if these numbers come in better than expected, the market's gonna like that. I think employment data almost rarely comes in super hot. Initial jobless claims can. These are the figures we can expect. It's gonna be a big week of employment data. A lot of focus is gonna be on employment or unemployment data, whatever you want to call it. So just some risks for the week ahead. Now, for those of you that may be new to this channel, if you didn't know, at the start of this year, I gave you two portfolios that I thought would outperform. The first one was this 2024 top picks portfolio. It was just hyper growth stocks that I thought would perform really well in 2024. And then I also provided you with the undervalued portfolio here, 2024. Now, the undervalued portfolio is more of a conservative approach. There's more positions, less concentrated, more diversified, and we're going to go through each of them, starting with the undervalued portfolio. Now, year to date, it's returned 16.58%. The portfolio was started on the 1st of January, and you can see we've had some pretty linear returns all the way to where we are right now. We have sort of gone sideways here since about the 20th of March, but on a monthly basis, we're up 3.87% for the month of March. Now, the portfolio consists of these 11 positions. So we have Accenture, ACN, ASML, American Express, Alibaba, Salesforce, Cisco, F5, Alphabet, Nvidia, PayPal, and Charles Schwab. And it's mostly just tech names and financial names, and then we also have like Baba, which is, I guess you could say, tech discretionary, and then Google here, which is comm services, but also really technology for the most part. And this portfolio has performed really well. If we look at total gain, not every single position is a winner. ACN is pretty much flat for the year. We have a look at Cisco, down 1.19% for the year. Same year with Baba, 3.21%. And then we also have some big winners. Nvidia up 87% for the year. Look at American Express, almost 20% for the year. Salesforce too. A lot more winners than losers in this portfolio. Now, in comparison to the S&P 500, as you can see, if we look at it on a year-to-date basis, which is pretty much the last quarter, the S&P 500 has returned 10.79% right here. My undervalued portfolio has returned 16.58%. And pretty much from the get-go, it has completely outperformed the S&P 500 all the way to March right here. Even this month, it's outperformed the S&P 500. And I believe this week, the S&P 500 has beaten my portfolio. And a lot of this has to do with ACN. They actually have seen material downside this week due to earnings. The market didn't really like their guidance. So this might be one of the positions I look at in the portfolio and maybe change, but I will let you guys know on Twitter. But as it is right now, these are the positions at the start of the year. There are no changes to the holdings, and this portfolio has pretty much 2x the S&P 500, almost 2x year to date. Now, this doesn't actually include dividends, and this portfolio has almost 2x the S&P 500. Now, looking at the top picks portfolio, this is a more concentrated portfolio. There's only 5 positions, and it consists of AMD, Celsius Holdings, CrowdStrike, Alphabet, and Nvidia. So it's pretty much all tech names, mostly semiconductors, one cybersecurity name, and then a staple, consumer staples, but it's a growth staple name. Now, looking at gains, every single position is in the green. Google, the worst performer, up 9.24% for the quarter so far, year to date. Very crazy when you think about that's the worst stock. Normally, you'd see something like that, 10% for the quarter, and that'd be your best performing position. But this is the environment we're in right now. In comparison to the S&P 500, looking at month-to-date performance, they've roughly performed the same. Looking at year-to-date performance, we have completely outperformed the SPY. Now, I don't know why it's like this. It says 38.64% return right there year-to-date, but up here it says 43.75. This is the actual position right here, and I'm going to put below links to track these portfolios in real time using software called Composer. But all in all, the actual return of the portfolio is 43.75. I don't know why this always says here when I compare it to the S&P 500. But all in all, guys, these are the 2 portfolios I've given, provided complete transparency with these portfolios and delivered so much alpha. I actually hold these 2 portfolios in my actual stock portfolio in these sizes. You can actually see I own 18 shares of Celsius, 8 of AMD, 2 of Nvidia, 8 of Alphabet, and I tried to make both of these $10,000 positions. Now, it was Australian dollars. That's why the gain, it started off at like 7,000 American dollars, and we're now sitting at 11k US dollars. And yeah, that's about 15,000 Australian dollars, maybe a little bit more than 15,000. But all in all, guys, if you want to go add these portfolios, these are the positions, this is the sizing, it's equal weight, and I do think both these portfolios are going to perform well for the rest of 2024. There's a lot of gains being made here in the top picks, and if I was to personally double down into one of these portfolios, I would probably look at the undervalued portfolio just because there's more diversification, and I think downside protection in this portfolio versus the top picks. I think if things really start to go wrong in the economy, that top picks portfolio is going to get hit really, really hard. Whereas this portfolio will also get hit hard, but I think the downside will be very, very limited in comparison to the top picks portfolio. But that may be outweighed by the gains I've had this year. And, getting 43% back in a single quarter on your money is absolutely crazy, all things considered. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.